Hope everybody's doing well today. We're going to do a short recap on the stock market and then shift towards interest rates here in just a moment. But let's talk. So, a few weeks ago, the Fed chairman Powell made it very clear at his speech in Jackson Hole that they are determined to get the inflation rate down to their target level. We've talked in a few videos about what that target level is. They further clarified their guidance in this speech, or Powell did, about where they wanted that inflation rate at the end of the year, where they expected it to be, and so forth. All that expectation created uncertainty, but it certainly drove home the point that the Fed is determined to do whatever it takes, and that has scared some short-term investors. It's created a lot of volatility in the past couple weeks. Now, what do we do about that volatility? We've talked a lot in videos about how we respond as long-term investors to short-term volatility. I encourage you to go back and look at the last 3 or 4 because that will certainly make it clear as our opinion on the matter has not changed. Now, the good news is, if there, certainly we try and find some good news in all situations, is that we're starting to see better interest rates in the banking system. Now, for a saver, someone with a savings account and they're looking to save and earn and hopefully do a little bit better than zero on their savings, which we've gotten so used to for so long, we're actually starting to see rates in the 2 to 2.5% range. Now, again, as we talked about a year ago, a lot of these are high yield savings accounts that are online only. Your traditional banks like Wells Fargo and Chase and so forth are still fairly low on their interest rates, and it will probably take quite some time for those big banks that already have a lot of cash deposits on the books to come around and start raising those rates. Want to offer a bit of caution though. So as you're seeing these interest rates improve, we're starting to get back into the territory of, are CDs the right choice for fixed income and so forth? And I think you have to be careful about locking up your money in a rising rate environment, because presumably, let's say you bought a 5-year CD right now. So you lock that in for 5 years. Well, if the Fed keeps raising rates, that 5-year CD rate's going to look better and better. But if you locked in a few months ago, there's really not much you can do without severe penalties to get that CD with a better rate. So you have to be careful. Now, there's a strategy for how to approach that. I think it's beyond the scope of this video, but certainly if you want to talk about how to work that type of strategy into your financial plan, we can. Give us a call. Again, I hope everybody is doing well. I hope everybody had a wonderful holiday weekend. We'll see you soon.